Get ready to find your recipe for a successful real estate lifestyle from America's top expert here at Greenlight REI with your host, Lance Edwards.
Well, hello everyone. Welcome to this edition of Greenlight REI, where you're here to learn about the successful real estate lifestyle. And we have today's topic, as I know, a topic from always top of the list when it comes to doing real estate deals is how am I going to get this thing financed? What are the terms? What's available out there, et cetera? And so I'm very pleased to be able to introduce Mr. Rick Cavan, who is an expert in lending, particularly in the world of commercial. He does residential as well, particularly in the world of commercial. He's actually working with me on a project right now. And Rick's with Skyline Associates. So, Rick, welcome to Greenlight REI.
Well, thanks, Lance, and thanks for letting me join in on this too.
Well, Rick, I'm really anxious to pick your brain here because I know people are going to get a lot of value. I can anticipate a lot of the questions. So I'm going to start off with some basic questions and just assume most of our listeners are kind of at the basic level. So you focus in the world of commercial lending versus residential. What's the distinction and how do the two differ? How do the two differ, Rick?
Fair question, good place to start. Residential financing, anyone that is going to be assisting anybody in the purchase of a residential property, which is any type of property that is 4 units or less, has to be licensed by that state in which the property is located. So if I happen to be in California, if I'm doing a residential property, somebody calls me up and they want to buy a home in Arizona, I can't do the loan because at the current time I'm not licensed in Arizona. So that's the first main distinction. Commercial properties, on the other hand, can receive assistance from me and other people that may be doing similar type of assistance that I'm doing anywhere in the United States. Heck, anywhere in the world, if you can find a lender that'll handle it. The licensing requirements are completely different. Understanding what a commercial property is as opposed to residential is the other significant difference. When someone is purchasing a residential property, they have to qualify for that property in terms of their income, their credit, their cash reserves, and how much money or how much they're going to put down if it's a purchase, or how much money or equity is in the property if it's a refinance. With commercial property, well, I sure thought that was turned off. I apologize. With commercial property, the income that is generated by the property is the income that is used to determine the loan amount for that property. And that particular difference is probably what causes more concern and questions throughout the financing of a commercial property. Understanding that the borrower is the actual commercial activity, whether it's an office building, a apartment building, mobile home parks, activities that are generating income of 5 units or more, if it's residential. The income that's being generated is what determines the amount of loan that can be justified. One quick sentence: I could be working with a borrower that makes $100,000 a month, wants to buy a 15-unit apartment building, and if the revenue of that apartment building is not generating sufficient funds to service the debt, or to service the debt that the buyer wants, we don't have a loan.
Which is completely contrary to somebody, for example, buying their houses, which is all about your personal income and your ability to service the debt. It's about the property's ability to service the debt in commercial.
Correct.
All right. So one of the let me throw this out because this prompted it. One of the things I know that get looked at a lot is this debt service coverage ratio, meaning how much is the income relative to the debt service. So in today's environment, Rick, what type of debt service coverage ratios are the lenders looking for to be able to say this property has sufficient income to cover the debt?
The debt service, I sometimes it's called DSCR for debt cost ratios. They can range anywhere, well, back in the Wild West, 2006, 2006, with 7 and 8, it started to get a little tighter up. I mean, we were looking at DCRs as low as 1.0%. And now, depending on various lenders, we could be as high as 1.5%. So the question is, what the heck is a DCR? What is 1% and what does 1.5% mean? And why does it exist? And what am I seeing right now? To back into that, what I had said earlier is that you're looking at the income of, let's just use a 15-unit apartment building as an example. We're looking at that income that comes in on a monthly basis, and we are backing into the maximum amount of loan that can be serviced by that income. And by the way, what I'm going through right now is the first thing I learned the first time I ever did a commercial loan almost 20 years ago. Okay, because I did not know this formula, and I essentially I was the dumb guy that called up the commercial lender that had to have everything explained to him as to how this is being done. So been there, done that, and I know what this is like. But there's an actual formula that every single commercial lender goes through to determine how much of a loan a property can service. There are 5 variables, and those variables will be determined by the lender, but the variables, the fact that they're all there, all exist. So if you had a 15-unit building and each one, let's say it was $1,000 a unit that was coming in, you got 15,000. The first thing that's going to happen is we have to allow for vacancy. That's the first variable. So we take off the vacancy. Then what we do is we have to allow for expenses. So then we have a number, we annualize all this. We have a number for expenses, a percentage. It can vary from lenders. Generally speaking, default is 5% on vacancy, 35% on the interest. The third variable is the debt cost ratio. Let's talk about what the debt cost ratio is. In the example I just gave, do you want me to go into this kind of detail? Because I can tell you exactly how it is.
No, okay, please. I think this is important. I think this is key. This is key.
Okay, so let's say it's a $15,000 a month that's coming in, and there's a 5% ratio. So on an annual basis, that's $180,000. And you take 5% off of that, and now you have $171,000 available to service a loan. But now you have an expense. Expenses can vary from lender and lender. The default expense that I would recommend everybody use is 35%. And that is used because if you have an apartment building and your expenses are way more than 35%, then you got a problem with the apartment building. A lot of times they're less than that, and we will still use 35%. They will still use 35% in underwriting. Even though the actual expenses are historically only 25%, commercial lenders will still allow for 35%. So now you take 35% off of what was $171,000 after you took the vacancy, and you come up with $111,000. Now we come into debt cost ratio. Let's understand what that is. When I first started, I always thought debt cost ratio, and what you're doing is you're taking a little haircut on that $111,000 figure. And I used to think at the beginning, well, that was really nice of lenders. They want the owner of that property, to make a little bit of a profit. So let's cut it down a little bit to leave a little bit of money so that this owner can actually, have a return on his or her investment. And do we want that owner to make 25%, or do we want to make 35%, or maybe only 10%? Because we really don't care about it. And so let's just do a DCR of 1.10. That's what I thought. That's not the reason. The reason is that lenders want to allow for emergencies. A boiler that blows up, water pipes that break, maintenance that has to be done that wasn't in the budget. So what they do is they give a haircut after you've taken off for vacancy, after you've reduced the annual income, anticipated income by an estimated expense. You take another haircut of 25, 35%, just as a cash reserve to just kind of put to the side in case there's an emergency that happens during the course of the year. There'll be enough funds to handle that. Generally speaking, I use 1.35 as a DCR in calculating or backing into the loan amount. There are lenders out there, and what I'm seeing is that it's usually ranging between 1.25 and 1.35. Have I seen lenders come back and do at 1.45? Yes. Do I yell and scream at them? Yes. But it's the old golden rule. You know the golden rule, Lance, right? He who has the gold
He who has
makes
the money.
rules. Yeah.
Yeah.
And so you fight the argument, you do what you can, and sometimes you win. But 1.25 to 1.35 is what I'm seeing, and with 1.35 being the maximum. Again, back to the Wild West days, I actually could see it at 1.0. In other words, they didn't give any kind of a hit. The bigger the hit, the less money you have available to service the debt. So that's it.
That's perfect. That's perfect. Let me interject here. So that's perfect. There's a ratio now. We're recording this. This is in July, end of July 2020. We're in the midst of this COVID stuff, pandemic, uncertainty about people paying rent. How has that affected the underwriting guidelines on these commercial loans during this time, Rick?
I have lenders that are doing a do not ask me any questions, do not argue with me. This is the way the cow ate the cabbage. 20% off of whatever you're telling, whatever the historical documents are showing and the current rent rolls are showing. So if somebody's got rent coming in at $20,000 a month, they're only going to get $16,000 a month to start with. So as of right now, I have two groups of lenders. Ones that are doing a straight on 20% hit to the monthly rent or income on that commercial property. I am actually dealing with lenders right now that are just looking at the property and making a gut call. It's like what underwriting was like for residential back in the 80s and 90s that I'm aware of. I don't know about the 80s, but where there was a lot of subjective decisions that were going into, or subjective opinions that were going into making decisions on residential properties. Once credit scores came out, once underwriting guidelines got tightened up, subjectivity in residential doesn't exist very much. Commercial, it still exists. You can still talk to lenders and explain to them why this particular property should not be subject to that reduction.
Okay. All right. Very good. And what about reserves requirements in this COVID environment? Have the cash reserves requirements, have you seen those go up on these commercial loans?
Generally speaking, they want to see 6 months of housing expenses as a minimum in cash reserves. I have not come across where that's been a problem. Now, that could possibly be that the borrowers that I've been representing and assisting, cash reserves was just not an issue on the table. But so it's just never come up. Even if underwriting was going to be reducing the cash reserves because of the pandemic, it never got to me because it was never an issue. Anyone that's looking at purchasing should anticipate a minimum of 6 months of the housing costs, and I'm using housing even though recognizing the property could be an office building, the cost for the principal and interest on the mortgage, the cost of the property taxes, and the insurance on that subject property. And they should be looking at 6 months of that as a minimum cash reserve requirement.
Okay, very good. All right, and of course, one of the topics of many people are familiar with, and I want you to explain it. We get in the world of commercial, we have the world of recourse loans versus non-recourse loans. So can you, I guess, start off first of all, basically just defining the two, and then if you would, elaborate on one versus the other. How do you get one versus the other?
Sure. A recourse or non-recourse is another way of just saying guaranteeing or not guaranteeing the loan. Comparing with residential, you buy a house, guess who's responsible for that loan? The person who borrowed on the loan. And as a result, that person is guaranteeing that that loan is going to be paid. And if not, the lender forecloses upon them, it's going to be a reflection on that person and on that person's credit, and that foreclosure is going to show up. So on commercial, however, remember, going all the way back to the beginning of this conversation, the building is the borrower. So I'm, obviously I need a real live person that's going to be borrowing the money. But if I'm signing all the loan documents and everything, but the amount of loan that has been determined for this $15,000 a month apartment building is $1 million, and I'm the one that's signing the paperwork for that. But the approval of that $1 million had nothing to do with what my expenses were or what I had in the bank as it relates to my personal, cash reserve. It was all related, especially as far as income, for the building. So why should I be held responsible if all of a sudden everybody moves out, or all of a sudden a pandemic comes and nobody pays any rent for 6 months, or things that I don't have any control over? I don't want to be responsible for that. I got another thing I don't want to have. I don't want $1 million loan showing up on my credit report.
Right.
So how do I, as the person who's signing the loan documents, even though it was the revenue of this apartment building that was determining how much of a loan was going to be reflected in those loan documents, why am I being held responsible if I can't make the payments? It's not because I'm not collecting the rents, because nobody's in there. So I go to that lender and I say, I want a non-recourse loan. I don't want to have any recourse if there's a problem. In other words, I do not want to guarantee this loan. If this blows up down the line, and I'm such a good manager, the only reason it's going to blow up is if there's a pandemic or something like that. It's not going to be because I had poor management, hired a lousy property management company, allowed the apartment building to just deteriorate to a point that nobody wanted to live in it anymore, or pay that $1,000 a month, and nobody would do that. That won't be the reason. It'll be for these other things I don't have any control over. Irrespective of that, I go to the lender and I say, I don't want to be guaranteed for that. You have 3 options at that point. The lender says, no problem, we do offer non-recourse loans. We offer loans that you don't have to guarantee. There's going to be a small little add-on, let's say 10 basis points. What does that mean? Instead of an interest rate of 3.5%, you get the non-recourse feature and you pay 3.60%. That's 10 basis points. That's option number 1. Option number 2, the lender says, go pound salt. I don't do non-recourse. Anybody that's going to own this property and have more than a 20% interest in this property is going to sign a guarantee for this loan. And if you don't like it, go find another lender, period, end of story. Sometimes people will buy properties with an LLC. There might be 5, 6, 7 people that get involved. They're all partners. There are 5 people that are involved. All 5 of them own 20% of them. Guess what? All 5 of them are going to have a guarantee that they're going to sign if they want that particular loan. The third option is what we call non-recourse lenders. And there are lenders out there that's all they do is non-recourse, non-guaranteed loans. And why do they even exist? Why would there be a market for them? Because if somebody is going to be using as a source of the source of funds that someone is going to be using to buy a property, to put the 25 or 35% down that they have to put down on a property to buy it, is an investment that they're using money from their retirement funds. Since 2004, if those retirement funds are being used, the loan has to be non-recourse. The argument being is that you don't want people with the retirement funds really jeopardizing the use their retirement income. You don't want them jeopardizing it. So there is a requirement that they have to use they have to get a loan that's non-recourse, which generated a little cottage industry. And it's not so little, it's pretty big. That cottage industry says, no harm, no foul. We will do non-recourse loans, no guarantees. Problem is, and I'm working with borrowers right now that are interested in non-recourse loans, and which is fine. And I've done the research on that. And what I'm doing is I'm finding interest rates that are ranging between 5.5% to 7.5%. Given right now, rates on commercial loans, and maybe we'll talk about this a little bit later, depending on the project, depending on where it's located, depending on what kind of commercial property it is, it could be the high 2s to the mid 3s. So somebody has to decide if they're not using retirement money, but they want a non-recourse loan, whether they want to pay an extra 2 or 3% on their interest rate to get that to not be exposed.
All right. Well, that's exactly where I'm going to go next is turn. But before I do that, I want to let you know, people are going to want to get in contact with you, Rick, to avail of your services. So real quick, how can people get in contact with you in regards to their lending needs?
Well, you can come by my office anytime you want. I'm in Southern California, I'm a block from the beach. So if anybody wants to come over, they're more than welcome to come. I'm in Orange County, Newport Beach area. If you want to reach me, my company is Skyline Associates. You can reach me via email. My email, my last name is Cabin, just like house, C-A-B-I-N. I think it's even on the screen maybe. But rcabin at Skyline Associates, plural, skylineassociates.net. If you send it to skylineassociates.com, I don't know where it's going, but it's not coming to me. My direct line in my office is a 949 area code, 949-644-6240. I also have an 800 number, fax number. I'd be happy to share all those with you. And I have a cell phone number, but the 949-644-6240 number is pretty much always going to come to me. When I leave my office, I tend to forward the calls to my cell phone, and those numbers are available. Do you want me to take up time to go over those 3 numbers too? But
I'll tell you, go ahead. Yeah, go ahead and do it now. I'm going to put them on the show notes as well. Go ahead and give them out too now, Rick. Okay.
Well, the 800 number, if anybody wants to use that, is 398-1694. 800-398-1694. It's not being used quite as much as it used to in the past because everybody just doesn't use 800s anymore. But it's there if anyone wants to do that. My cell phone is in the 714 area code. Cell phone number is 318-6962. 714-318-6962. If somebody still has a fax machine or somebody still wants to fax, knock your socks off. You can now that one I do have to look up. Oh wait, there it is. 610 is the area code, and that goes directly into my computer. It's 610. Oh, that's a different number. Hold on. I'll come back to my fax number. I just don't use it very much.
All right, we'll get that one later.
575-37. No, let me come back to it.
All right, but anyway, plenty of ways to get a hold of Rick. I'll go ahead and tell you right now, the man's comprehensive in his email correspondence. He's very, very detail oriented, as you can tell just talking to him. All right, so I want to come back to something. So I know this is a question. You already started light on this, terms. So you started to talk about what kind of terms should people be looking for in terms of interest rate, down payments. Talk in terms of that, Rick, on these commercial products.
Sure. Let's first talk about equity or down payment in purchasing a property. Commercial properties let me back up a second. There are a lot of different kinds of lenders that are out there, from massive big lenders. Fannie and Freddie will loan a lot of money on apartment buildings, down to small private investors. There's a lot of ranges in terms of what the money is used for and the kinds of property that are being involved. So what I'm going to be doing is giving a general overview in terms of the more popular types of commercial properties that people tend to get into the first time they do this. Mobile home parks is not usually the first kind of commercial investment that people do because it can be sometimes a little bit weird. Construction of big shopping centers is usually not it because that's a whole different ballgame when you don't even have a tenant in there. So office buildings, apartment buildings tend to be more common. So these are relating to those kinds of properties. Generally speaking, the down payment is going to be a minimum of 25%. Their loan to value, and I assume people watching this know what loan to value is, the value, okay. So You're looking at a 75% loan to value on commercial properties, and I will tell you right out of the gate, that's an aggressively high loan to value on commercial properties. Most of them will be in the 70 to 65% range. Can we do 80%? Absolutely, depending on the type of loan that's going on. There are some lenders that will go out there, and investors that will go as high as 80% loan to value on a commercial property. Usually, well, not usually, it is rare. It's rare. 75%, you're kind of pushing the envelope as it is. In terms of types of loans, if people are familiar with, the traditional vanilla 30-year, 30-30 loan on residential, that loan has taken a hike. It has left the building. I've been doing this for 20 years. I've never done a 30-30 commercial loan. It doesn't exist. Commercial loans generally come in the categories of fixed rate periods, and those fixed rate periods are 3, 5, 7, and 10. And in those 4 examples, 3-year fixed, 5, 7, and 10, in those examples, the monthly payment will be determined on an amortization period of 20 to 25 years. Most lenders, investors that do this will come back and almost always ask for 25 years as the amortization period. So the rate may be fixed for 5 years, let's say 3.5% fixed, amortized over a period of 25 years. You figure out what that is, and that's your payment for that 5-year period. Interest rates tend to be slightly higher as you lengthen the fixed rate period, which is consistent with residential. But the amortization will be over a 25-year period. A lot of times you will see investors that want to amortize over 20 years, which raises the monthly payment. 2 problems with that. The biggest, of course, is that your payment's higher. But bigger problem, in my opinion, is that if you have a higher payment, if you have a shorter amortization period, that was one of the 2 remaining variables that we didn't discuss when we were talking before about that. How do we back into the loan amount? The last 2 remaining variables are the interest rate that you plug in and the amortization period. Because you could have a low interest rate, but if you have a 15-year amortization period or a 20-year, your payment has just gone up and you get a lower loan amount. So that's one of the problems with having a shorter amortization period. So you get a lower loan amount and you get a higher payment, not something neither one of us wants. That being said, I am currently working on a 36-unit apartment building in Los Angeles, and the quotes that I'm getting are 30-year amortization. Knock your socks off. So when I say that's rare, I'm exaggerating. In other words, it's rare to get a 30-year amortization. It can be done. Well, let me rephrase that. I have lenders that do 30-year, but their interest rates are a little bit higher. So it tends to be kind of a wash. But this particular program is going to be very aggressive interest rates in the 3s and a 30-year. There's a good program. But it's right smack dab in Los Angeles. It's 36 units. It's debt servicing way more than the loan amount we need, blah, blah, blah. In other words, the lender wants that property.
Yeah, good. So we got 70-75% loan to value. You got fixed terms or balloons, 3, 5, 7, 10 years, fixed, 20-25-year AM, pretty much you count on, and interest rates around 3.5%. Is that kind of what I'm hearing, Rick?
Yeah.
Or less?
Rates on a good project will range anywhere from the low 3s to the high 3s. This aggressive loan that I got was a 10-year fixed, and it went as high as 4%. And that would be for, they were just giving me ranges anyway. But that was the first 4% I've seen on an A-paper, A property type of loan.
Wow. Now that's on a purchase. What about on a refinance? And let's say you want to do a cash out refi. How the terms differ there?
Rates are and really only slightly different, and different being slightly higher. But this deal that I'm talking about is a refinance. It's not a purchase. And that's how aggressive they are on that particular one. Where you reach a problem is if you're doing cash out. Now, lenders on commercial loans are not keen on cash out unless their investment is being improved as a result of the cash out. So whereas, and I apologize for making these comparisons to residential, but people tend to be more familiar with residential, but if anybody's ever done a cash out residential loan, this is not as popular as it was before, or demanding as it was before, but a lot of times they had what we used to call a cash out letter. What are you going to do with that money? And in the residential, we learned how to answer that question so the lenders would leave us alone. So now the lenders all figured that out, and so now they don't ask the question quite as often. Commercial is a completely different story. Now, when they say, what are you going to use the money, they mean, what are you going to use the money? And so if you're going to be doing a loan that has a $1.5 million cash out, they go, whoa, hold on a minute, Jack. And they will ask, what are you going to do with it? Well, I'm putting a new roof on the subject property. I'm going to be painting it. I'm putting new air conditioning in all the units. If you do all that, they'll give you that. They'll do that loan. They may make arrangements on how that $1.5 million is dispersed, depending on what you're going to do. Let's say it's only $150,000. They'll still ask. And if you're going to, repave the parking structure, they're okay with that. If you say to them, I'm going to buy another apartment building, I'm going to use it to send my kids to college, it's none of your business. I get that from clients. Just tell them it's my pocket change. I say, not that way, Lenders will back off. So, yes, you can do cash out loans. You better have a good reason as to what you want to do with that cash out loan. Can you use it to send your kids to college? I'm not saying you can't. I'm saying you're going to have to explain that, and we're going to have to find a lender that's okay with that. It's not impossible, but it's going to be a challenge. I wanted to add one thing to
go ahead.
I said earlier. Those short-term fixed-rate loans, they don't necessarily have balloon payments at the end of those periods of time. Some of them, there's two main options that are associated. Some of them will have built in what happens at the end of that. They will actually say, for example, you can have a 10-year balloon with a 5-year fixed. At the end of 5 years, they will recalculate based on whatever the current bonds and yields and whatever they're using as the index to a new 5-year fixed. 5-year swaps is a type of index that is sometimes used in commercial loans. And they will calculate what the new 5-year fixed rate, and then they'll fix it again for another 5 years, and then they'll have a balloon. So you'll have that built into it. I have lenders that will do a 25-year fixed, a 25-year amortization with 5 fixed-year periods, and they'll build it into the loan. So every 5 years, it's just readjusting to whatever the current market rate is charging for 5-year fixed rate program. However, even if there is a balloon, investors don't want to walk away from a performing loan. So if you've got a loan that was a 10-year fixed, amortized over 25 or even 30 years with a balloon at the end of the 10, it's written right there, black and white. You're going to sign a loan document that says balloon. You have to pay that whole thing, I promise you. If you've been making payments all along the way and it's 9 years from now and you're getting your year out, you're going to call up your lender, and the lender is going to be doing everything they can to keep you from having that balloon payment. So even if you have a balloon payment, if you pay during that fixed rate period, or even if you roll over to an adjustable, some of the loans will stop and then they'll roll right over into an adjustable rate mortgage pursuant to whatever index and margin is written in the loan. But at some point there may be a balloon. I tell my clients, don't worry about it. I mean, worst case, you'll have to call me up again, and God forbid I'm still doing this. But no, if I haven't, that's a joke. I will get another loan, but chances are you're going to be able to call the investor and get that loan extended.
That's valuable information. And just that one data point right there, everybody, just the fact that those balloons they're not necessarily in granite. It's just maybe a phone call. You want to extend you don't want to take it off. You want to extend it. As long as you've been performing, they got an incentive to keep taking your money. That's what I'm hearing.
No, let me rephrase that. It is 100% in granite. It is real. You have a balloon. I don't want anybody coming back to me in 10 years and saying, hey, Rick, you told me I could, because that lender doesn't have to say, okay. I've been paying on time every time for the whole 10 years. The lender says, we're out of the commercial loan business. Thank you very much. Go find your money, and you want our balloon payment. So it is rare that they will walk away from it, but it is in cement. If it says balloon, it's a balloon. It's just rarely enforced because, generally speaking, lenders don't want to walk away from performing loans.
All right, very good. And I've got one last question, Rick. And the thing we haven't talked about, we've covered a lot of ground here. One thing is the timing. How long does it take to get from start to finish on a commercial loan, and how has it changed with COVID? What should people anticipate? Timeline.
Well, it's been like this. Commercial loans, everything's cool. COVID, everything came to a screeching halt. So I have no idea what the problem, because nobody was doing any loans. To where we are right now, which is back to the old days, which is they're doing it. During the COVID period of time, it wasn't that they didn't want to do the loans, but major investors, there was loans that were being done during COVID, but the major investors, the ones with the most aggressive kinds of pricing, were heavily involved in the PPP pricing, PPP loans, emergency loans, a lot of government SBA loans. And they just took all the personnel that were working on commercial loans, took them off of the commercial loan and stuck them over in the PPP programs, emergency programs. And that's why things came to a screeching halt. So I haven't had any experience. Now that things are wrapping up again, I'm getting the same timelines as I always got. So the pandemic issue is, at least now, is not impacting. Can that change down the line? Who knows? But as of right now, it's the normal timeline. So do you want me to talk about the normal timeline?
Please.
Okay.
Yep.
The process in getting a commercial loan is unchanged in the 20 years that I've been doing this. And that is that the first thing we have to do is we have to find lenders that will loan on the property that the person wants to buy or refinance. And the decision on whether or not a lender will even loan on that property, other than having kind of a gut feel as to how much revenue is being generated each month, there are a couple of main factors. One, what kind of property is it? Some lenders won't do. I keep falling back to mobile home parks, but some won't do it, period. To them it's land. And land's a whole different discussion we'll save for another podcast. The biggest factors, of course, are after you've determined whether or not you got enough funds to service the debt you want, is where is the property located and what's the size of the loan. And the answer to those two would be what you would expect, that the more population, the more metropolitan the area is, the happier lenders are going to be, and therefore the more lenders you'll have available to compete on a particular pricing. And two, if the loan amount is high enough to justify them spending the time to underwrite the file. And what one person or a borrower or buyer's definition of high enough and what a lender's definition of high enough, there can be a big gap between the two. So assuming we are dealing with, so what the first thing has to be done is that we have to find lenders that will loan on a particular property based on where it's located and the amount of the loan. And that's where the services that I do that come in. So this is all part of the timing factor, because this has nothing to do. Here's the short answer to your question, Lance. Once we have a lender identified and a loan program that we want to do, and we haven't done an appraisal yet, I required to get a certain documentation, which we can talk about in a moment. I now have that documentation. I submitted to underwriting. 45 to 60 days we close. That's a very good range. That's from the time we submit the documentation being requested to the day to close of escrow, 45 to 60 days. That includes the time that's required to do any appraisal that's going to be required, and you're going to get a commercial appraisal. It also includes certain environmental work. I was doing a office building in Baton Rouge. Life is moving along. It's wonderful. It's great. They do an environmental, and boom. In the 50s, there was a gas station that was on that exact corner. They tore it down. They built this building, and now everything came to a screeching halt because we had to find out they tore up the parking lot and they got dirt samples to find out they're and anyway. But so environmental can be involved, the appraisal, but assuming everything is good and there aren't any of those kinds of problems, 45 days is at the quick end, 60 days is at the long end. That's the range that we give, and it's almost like 100% of the time if there's not a problem from the time we submit. So that answers the question, how long does it take? Now let's talk about submitting all the documents. First, we have to find lenders. That can take time. There are clients that I work with depending on where they're located, depending on whether they want recourse or non-recourse, depending on the size of the loan. I mean, I was doing an apartment building in Los Angeles that serviced a debt of a couple of million. The lady retired, owned it free and clear. She just wanted some cash, and she just wanted $200,000. And I said, put it on your credit card. You know, it's like, and it wasn't that the lenders didn't see that obviously we can do 200 grand. It was, that is so below anything that we'll do that we're not going to do it. So that's an extreme example, but my point is that there's research that has to be done to find lenders. Now that you find lenders, you want to give them enough information to whet their appetite and to make sure they really want to do this property and do this financing. And you want to find out, okay, now that you've sent me these documents, which we'll talk about in a minute, do we have time to talk about what documents are going to be needed?
Sure,
okay.
Sure.
Before we get to that, we show them the documents that they ask, which are like preliminary documents. And they look at it and they say, this is good, we'll do it. My responsibility, or anybody's responsibility, if they want to even do this on their own, is you ask for a letter of interest, LOI. And what an LOI does is it's from the lender, it's on their letterhead, and they say, here's, thank you very much, here's the property. And it may be one page, it's usually around 3 pages, because in those LOIs, they say this is the interest rate, it's all subject to the appraisal, it's all subject to the environmental. But if the appraisal comes in, the environmental is good, and whatever additional due diligence that we're doing on the loan, assuming all that is cool, we will do this loan at this interest rate over this period of time. It'll cost you this amount of money, and rock and roll. Period. End of story. Oh, and there are going to be certain third-party costs. The cost of the appraisal is estimated to be $2,500. Cost of the preliminary environmental may be $500. So if you're good with this LOI, you sign it, you got a check to us for $3,000. Anything that we do not spend will be reimbursed to you at the end of at closing in escrow, assuming you're in escrow state, and we move forward. However, it could take a whole month just to get to that LOI process, because there's research and funding. It could take just a week or two, but that is added to the 45 to 60 days. Okay.
So let me interject here. I want to talk about the data in just a moment. But so the question I'm going to put to you is, so when is the best time to engage you, Rick, in the process of acquiring, say, an apartment building? When would you like them to be engaged with you?
Understanding that the borrower is going to be the apartment building. When a potential buyer who wants to invest by purchasing an apartment building can determine what, I need one piece of information. I need to know what the current rent rolls are on a particular apartment building. And I started to tell you what the 5 variables were. When I first started and learned what these variables were, I created, and it's been fine-tuned over the years, because we get into cap rates, which we don't want to get into today because it's really weird. But my point is that I created an Excel spreadsheet. You tell me how much money is coming in each month, I enter that number, and boom, I can tell you exactly whether you are whether the loan amount is going to be within the ballpark you want. If the answer to that question is yes, that's it. That's exactly what, that's cool. I can do that. I have the down payment. That's the loan amount I'm looking for. Then I will explain what we need to get the LOI. So it's not while the guy's thinking about it. It's not like buying a home for yourself, where you call me up and you want to get pre-approved for a loan, and I gather all this information and I find out how much money you earn, and we back into how much it is. I'm essentially doing the same thing for the loan amount. And I have just one more comment to say about this before we get off, because it's very important. The income that we're getting on the property, the reason I say we need that current rent roll is because it's like me asking someone who's buying a house, I need to see your W-2s, or I need to see your paycheck stubs. I need to know how much money you make. With this, I need to know what the current rent roll is. Let me tell you what happens when somebody is buying a apartment building, they will talk to a real estate agent and they will get this really fancy, sexy brochure. Hey, this is how much money we earn. This is how much money it's going to earn. This is what we project. This is what the expenses have been. This is just like printing money. It's going to be a beautiful, trifold brochure. Everybody has seen them. And potential buyers will send me, PDF files of those. And here goes the brochure. And I said, this is beautiful property. I can't use it at all. Period. I need a current rent roll. If a seller wants to sell their property, they need a real estate agent, and commercial real estate agents know this. Residential real estate zone, commercial say to that seller, give me a current official rent roll. I can't use what's on that brochure. So you have that official rent roll that shows what the current rents are for the most current rent. It shows the vacancy on that property. It shows what the gross rent is. I don't want estimates. I don't want, well, this is what it could be. I don't want brochures saying this is what it looks like it's going to be. That's what I need. So in answer to your question, whenever anybody has a number that is the exact number that they know that that's the number of current rent rolls that's being received each month on that property, call me up, send me an email. I'll tell them this is about how much you're looking at. I don't even have to know their name because, they're not the borrower. I'll ask them if they've been
good.
We do look at the borrowers. If they have bankruptcies, foreclosures, they can't afford to pay their own house payments, that's going to be a problem. But generally speaking, we're assuming that part's okay.
All right. So a final thing, and then as far as the data requirements, let's say they've given you a current rent roll. Now they want to go into a formal loan application process. What data is required for that?
95% of all LOIs, and it's probably even higher than that, that I generate are based on extremely basic information. That basic and very limited information. One is a current rent roll. Two is we need operating statements for the subject property. And there's 3 operating statements that we need. An operating statement is a fancy way of saying a profit and loss statement. We need the operating statement for the 2 previous years. And we need an operating statement on the subject property for year to date. So somebody's coming to buy a property tomorrow. I need 2018 operating statement, 2019 operating statement, and I need 2020 year to date, June, the first 6 months, and for that operating statement. Photos of the property. It would be nice to get, if again, apartment building, all 4 sides. It would be nice if we could get some photos of maybe a vacancy, if there's a vacant unit, inside, just to see, how sweet and cool it looks like or what it looks like. And photos are helpful. Sometimes people just don't have photos. When you are buying a property, that's the only time brochures come in handy because they tend to have photos all over the place. But if you're refinancing a property, sometimes you don't have the photos. Sometimes you have a property manager. You may not even live in the area where the property is located. So if they can get the photos, that would be great. 95% of the time, just on that information, current rent roll, operating statements, photos, we can do it. Now, what's happening is that lenders are asking for personal financial statements on the borrowers. I have blank PFS, their personal financial statements. I will, sometimes that's that 5% margin there. We'll get that. It's rare that we get into tax returns on the property or tax returns on the current owner. It's really rare, especially in a purchase. It's kind of hard to walk up to a seller and say, okay, we need to see your tax return for the previous couple of years. But if we have operating statements and they look pretty official, then we'll deal with that. There are variables, obviously. Sometimes you got new construction. There are no historical rent rolls. There are other things that we do. But once we get the LOI, based on that limited information, in that LOI, it'll say, okay, now here's what we do need. and they will ask for maybe tax returns of the buyer or borrower. And the other items we already mentioned, appraisal, environmental, and there may be some other. We don't even pull I don't pull a credit report. I can pull a credit report. I don't like pulling credit reports. It's an inquiry. I don't know whether it do anything. I'm not going to pull credit reports. The only one's going to pull a credit report is going to be the lender, and that lender's only going to do it after the lender has a signed LOE with a check for the third-party cost in their hands. Then they will pull the credit report, and then everything will be subject to whatever additional documentations are in that LOI.
Perfect. Rick, this has been outstanding. I mean, this has been soup to nuts. You've covered it. Really, I've taken a lot of notes here because what's going on today. So one more time, give everyone your one of your phone numbers. So we're going to post all your phone numbers on the show notes. Give them one of your phone numbers, your preferred phone number to contact you, and your email address so they can get engaged with you.
And I even have my fax number. While we were doing a direct line to me, which is either the 800 number or the 94 number are really the two best numbers to reach me, because like I said, my office number, which is a landline, don't anybody send text numbers to my office number. It is a landline. It's old school, but it is what it is. Landline 949-644-6240. That, if I'm out of the office, will automatically be forwarded to my cell phone if you want to text, 714-318-6962. My fax number, because I promised it, and I really can receive faxes, is 610-610 area code 643-5735. How about that, Lance? He actually has a fax. 610-643-5735. And finally, email rcabin@skylineassociates.net. Rock and roll. That's how to reach me.
All right, it's Mr. Rick Cabin on your commercial lending needs. Here's a man to call. Get in touch with him. He obviously knows his stuff. He's going across the country. Get engaged with him on your commercial lending needs. I tell you, he's a wealth of information, even in the email exchange. He's got it down to a science. So, Rick, this has been outstanding. I want to thank you for everything you shared here and for everything you're doing. And for everyone, just wrap up this episode of Greenlight REI. Remember, go out and make yourself a successful real estate lifestyle. And one way you can do it with this man right here, Mr. Rick Cabin. Take care. Till next session, everybody. Take care.
Thank you, Lance.
You've been listening to The Expert with Lance Edwards. Let us now blatantly and shamelessly bribe you toward creating your own real estate lifestyle by offering you a whole bunch of free stuff. Go to greenlightreinvesting.com and get you some free stuff and this session's show notes.